What's up, you guys? Zoe here from OneGlancetRader.com, and I'm super excited because in this video we're going to talk about how we can invest in stocks that we love at a massive discount. And not only that, I'll also show you once you're in these types of positions how you can reduce your cost basis to potentially reduce it to zero. So therefore, have no money down inside the investment, so you can ride the wave for absolutely free. And then I'll also be showing you a live example of a leap option that I've recently purchased and what my plan is, and I'll probably do a spin-off new series on it, so you can see this concept that I'm just going to show you, so you can see it every single week. And then we can take it from there. And if you like the sound of that, all I ask for is that you smash that like button, and don't forget to subscribe and hit that bell notification icon, because I'm producing weekly videos that are giving you some great tips in investing, options trading, forex trading, all that kind of good stuff. And so let's get into it. So you can see here that the massive opening statement is how we can invest in stocks we love at a discount. So how do we actually do that? By leveraging options. And we do that through what's called a LEAPS option. And LEAPS options stand for long-term equity anticipation securities. No idea why it's called that, but all I know is that effectively a LEAPS option is options contracts with an expiration date longer than a year. Now, so all it is uh, you're buying an option, so you have the right but not the obligation to purchase or sell, because if you think a stock's going to go up, you're going to buy a call. If you think a stock's going to go down over the long term, you're going to buy a put of the underlying asset at a predetermined price at its expiration date. And that's effectively what it is. A lot of you, I sell options. So in this particular example, we'll be buying options. So we'll be paying a premium uh, to have that right to buy a security at a predefined strike at a predefined time, which is usually a year or longer. So there are two main reasons why, and we'll go into the benefits in a bit more detail. If you think a stock's going to go up in the long term, whether it's a a growth stock or a small cap stock, or even one of the big boys like Apple or AMD, for example, if you think that the share price is going to be higher in a year or two's time, but you don't have the capital to go buy 100 shares of an asset, you can actually buy a LEAPS option, which is, and you'll see, is 70-80% cheaper than buying 100 shares outright. And that's the main reason. So if you have a small account, this is absolutely fantastic. So if we go through a stock portfolio example, I've just picked a range of stocks here. Not saying that you should buy any of these stocks. Again, this is not financial advice, but I've just taken different share prices so you can see the discount you can get from buying 100 shares at the current market price versus buying a 2-year call leap option at the money. So if we look at this, we've got Apple, AMD, ChargePoint, Palantir, Fubo, and Riot. And again, I mixed it up with different types of sectors so you can kind of see what the feel looks like. And I wanted to pick stocks with different share prices as well. You've got, Apple and AMD above $100, $150, and then you've got some, sub $20 stocks over here. So then we've got, what if we bought 100 shares? So that's just going to be 100 times by the current share price. And the total, if we bought 100 shares as of today, it would cost us just over $40,000. Now, not many people have $40,000 inside their account, and let's say they were bullish on all of these stocks in a couple of year time. So I believe that Apple, AMD, ChargePoint, Palantir, Fubo, and Riot will be above their current share price in 2 years' time. So what I can do is either buy the 100 shares outright for 40 grand, or what I can do is buy a 2-year LEAPS options. So I'm buying a call, so I want the stock to rise, and I'm buying the at the money, so at the current price, or the option strike price that is the closest to the current share price. And you can see here, for example, for Apple, if I wanted to buy that 2-year call leap option, it's going to cost me 3 grand, right? That is 83% less than buying 100 shares of Apple. So I can control 100 shares of Apple for 3,000 at an 83% discount. So if Apple goes up, my leap option will go up. If Apple goes down, my leaps option will also go down. And we'll go on to in the next slide about how that works as a percentage appreciation across the two. But you can see here it's the same logic across the board. And the reason why these shares have different discounts will be based on volatility, um, the um, the amount of interest there is at those options prices, how big the spread is, be various different things that make these prices. But you can see here on average across these shares, it's 74% cheaper, just a little over 10 grand. Now, a lot of my following will have 10 grand and above around that element. So you can pick these 6 stocks and control 100 shares of these at 74% discount than what they're currently trading at to buy 100 shares. And there's a reason why I've done 100 shares, which will go on to the next slide. So you can just buy fractional shares. If you've got 10 grand, you can just buy fractional shares of these companies. But there is a reason why we want to leverage options for this and not to do the fractional shares piece, which I'll go on to in the next few slides. So hopefully that makes sense. The difference is we buy a 2-year call at the money for 10 grand versus buying 100 shares for 40 grand, and we're actually gonna get more appreciation as a percentage across both, which we'll go on to right now. So if we go into an example, so I said that I purchased a leap option, and I purchased RIOT. So those of you who've been following my channel know that I'm a big fan of the crypto space, especially for Bitcoin. RIOT is one of the biggest leading miners based out of the US. And again, I've got a RIOT series which I'll link to somewhere on this page that you can see where I'm actually selling options for premium on a weekly basis. So what I did is I bought the January 19th, 2024, so just a little over 2 years out, at a strike price of $13. Now the current price when I bought the shares was around 23.72. So it's what's called in the money. So as per the previous slide, I'm not buying the 24 2024 call. I'm buying the 2024 call, which means that I'm buying my option in the money. And you can see that it's a bit more expensive when you buy in the money. It's a bit more safer because RIOT can afford to go down a little bit, and I can still exit the position inside profit. I'm not going to get into strike prices of leaps options. Comment down below if you want me to see or do a video on that, because I generally buy leaps options in the money, not at the money. But you can do it at the money or even out the money, so you can go even further out from the current price. So I bought one contract. We'll go into last in a second, and it cost me $1,630. So if we look over here, the leap cost was 1,631. To buy the shares will be just a little over 2 grand, and that's a 31% discount. And again, it's lower discount than the previous slide because I'm buying in the money as opposed to at the money. And there's a reason why I'm doing that, which I'll go on to inside a second. And so you can see here that my average price is 1631. The current price of the leap options is 1560. So RIOT has dipped slightly since I purchased the option of when I took the screenshot, and my option is now worth $73. So as RIOT goes down in price, even if I bought 100 shares, I would still be down in this position anyway. So I was going to be down. It didn't make a difference from that. But what's interesting is that as a percentage appreciation, as RIOT goes up in price, as the share price goes up, as an absolute, because I'm putting more money in, if I bought 100 shares, I'll make more dollar value. But as a percentage, because we're using options and we're more leveraged, from a percentage point of view, we actually make more of return dollar for dollar on our money that we've actually invested. So that's one of the benefits of doing a leap option, is that I'm bullish long term on Riot 2 years out. It'll be way above 23. It was at 40, like, let alone 4 weeks ago. So even if we went back up to 40, so that's pretty much 80% up. This option will be over 100% return. And that's again down to the leverage and the volatility that's inside the market to be able to do that appreciation from there. And the next best thing is you can sell what's called poor man's covered calls. So in my Riot series, if you guys have been watching, is I own 100 shares of Riot, and I've been selling covered calls every single week for income or to reduce my break-even cost basis. And you can do the same thing here, because you now control 100 shares of Riot with your leap option, and your leap option is your collateral as opposed to the 100 shares being your collateral. You can now sell covered calls on these stocks that you own leap options for. So, and we'll go on to that more and more detail about strike prices and various other things in the next slide. But that for me is the key of why I don't invest $1,600 in fractional shares of Riot versus, or buying 1,600 worth of shares, whatever that looks like in as a whole number, or it'd be a point decimal place number, versus doing a 2-year leap, because I've bought myself 2 years of time, right, to be right. And 2 years is a long. It's not even a long-term view. It's probably a short to medium-term view of the stock market. And as I said before, leaps are great for small accounts. So if you've got between 3 and 10K and you want to invest in the likes of Apple, for example, but you don't have, well, I don't know what it was, 17K or whatever it was, to invest, or at least put all your money into one position and not have a diversified portfolio, leaps are fantastic to do that. So again, that's why I go into leaps, because I can buy or invest in a stock cheaper and ride the wave if I believe it's going to 2x, 3x, 4x in in a couple of years' time. And the next best thing is the poor man's covered call. So as I said, we can now sell covered calls on Riot in this particular example, and instead of having 100 shares as collateral, I now have my leap option as my collateral. So if we look at, the first thing to do is, when you sell covered calls on a leap, is to determine what strike price. The expiration date, again, I'll be doing weeklies probably, but you can do monthlies or whatever you want to do when it comes to your expiration. But the key thing is to get your strike price right, because if you get your strike price wrong and you get assigned the covered call, your broker, depending on which broker you have, will automatically sell your leap option. And if you get the wrong strike, then you could be selling your leap option at a loss, right? So therefore you could, potentially make a small loss as part of the overall trade. So you want to make sure you get your strike price right. And there's many schools of thoughts on this. The best one, and to be the most safest, is to calculate your break even. So to calculate your break even on a poor man's covered call, is going to be your leap strike. So in my case, $13, and the cost of the leap. So it was $1,631. So if you divide it by a per share basis, that is 16.31. Add these two numbers together, my break-even price is $29.31. So when I sell a covered call, which I'll probably do today, because today's Friday, and I'll be selling a covered call for expiring for next week, I'll be looking to sell a covered call. Well, Riot's currently at 23, so I've been doing options for a long time now, so I'm quite comfortable selling options at below my cost basis. But for the sake of argument, I would probably sell this at worst case $29 or at $30 plus. But if you're brand new to this and you want to look at utilizing the poor man's covered call, I would be selling options above $30. Now, what happens then when you do that? So if I sold the 30 strike for next week, that's probably about $10. Let's call it $10, for example, in terms of premium. So I can use that premium as income. I can withdraw it, use it, spend it, do what I want to do with it. Or what I can do is look at to reduce my cost basis. So if my cost basis at the moment is 1,631, um, at this point here, or 1,630 to keep the numbers easy, and I received $10 in premium, I would then now have a cost basis of 1,620. So you will need a spreadsheet to maintain all your covered calls that you sell and then minus it from your cost basis. So therefore your break even over time will start reducing, and therefore you're lowering your cost basis, and therefore you can start, if RIOT drops, you can start selling covered calls further down, still above your break even as time goes on. But my point here is that eventually you got 2 years, right? And especially if the stock continues to go up, eventually your break even will be zero, because once you've made $1,631 in premium, you will then basically you would have taken all your money out of the trade, right? So therefore now you have a leap option that you can just continue to sell covered calls on, or sell your leap option, or whatever you want to do with it, and you will have a what's it called, the appreciation of that, and also free money from your covered calls, which is going to be, it's just going to be amazing. So that's why I want to document this series, because in the series that I've created where I'm selling the 100 shares, I've made about $850 in premium, and I think I've been doing it now for 16, 17 weeks. So just around 6 months. So in 6 months, I've made 800 odd dollars. So in another 6 months, in a year's time, if I keep that trend up, that's 1600, which is pretty much what my cost basis is. So in a year's time, potentially, hopefully quicker, I could have paid off in premium my $1,600, and therefore, assuming that RIOT is above the current price, my leap options will be positive, and I've got no money inside the trade. That would be absolutely brilliant. So that's the plan of what I want to do as part of this kind of video portfolio. Is to introduce you to the concept of leaps. Is to then show you how to do poor man's covered call. In the next video, I'll probably start my poor man's covered call series on RIOT, with the objective is to making this into a free trade. There are other things you can do as the price of RIOT goes up and your option price increases and you're positive, you can roll your option up. So rolling up your strike and taking out some money. So you can take out your 1600 if RIOT gets to 40, for example, and you've doubled your money. You could take out your 1600 and then increase your strike. Your break even will go up slightly, but then you can continue then as a risk-free trade. So there's many things you can do, and all of that probably went over your head, but I'll be walking you guys through it step by step in my new RIOT mini series. Well, it probably won't be mini, it'll take me a while to get down to 1600, but I'll be keeping you guys updated with that. So again, please make sure you subscribe. If you like the video, I'd really appreciate if you got some value from it. And then in the top right corner or in the thumbnails, you'll see the wheel strategy on RIOT as well, so you can see how I'm selling covered calls to reduce my cost basis and also to get some income. So hope you like that, and I shall see you guys in the next video.